Hi everyone. This is a short tutorial on how to sell a treasury bond in Fidelity. So we're on my Fidelity account right now, and you can see I own a short-term treasury bond that was acquired on July 8th, and it's a 3-month treasury bond that matures on October 10th, 2024. So today it is the end of August. So let's say, for example, we want to sell this treasury bond before it matures on October 10th. Now, most of the time, probably if you're selling a treasury bond, it might be a longer maturity treasury bond, meaning it doesn't mature in just a month and a half. However, the process should be about the same. The only difference potentially is for longer maturities, maybe it's a little bit less liquid, which impacts the bid-ask spread, which I'll show you in a moment. So let's just click Sell. That takes us to this screen where now we can look at this individual treasury bond. So again, this is a 3-month treasury bond that matures on October 10th, 2024. But now we are trying to sell it a little bit early. So what you'll see here are bid prices and ask prices. Bid prices are the price at which someone is willing to buy this bond. You can see here there's a bid price of 99.472, and then there's also a bid price slightly lower of 99.471. So remember, if we hold this bond to maturity, which is a month and a half on October 10th, we actually receive 100 cents on the dollar. So here, because we're potentially selling it a little bit early, whoever buys the bond from us also wants to earn a return, right? So in this case, someone's willing to pay and buy the bond at 99.472. The amount they're willing to buy is 10,000 times the face value of one bond in Fidelity is 1,000. So there's about $10 million in bid quantity at the price of 99.472. Now, because you'll receive 100 cents on the dollar by October 10th, you can actually calculate the return, but Fidelity also shows that right here in the bid yield. Basically, this bid price of 99.472 is equivalent to a yield of approximately 5.236. That's an annualized return figure. On the other side here, you see ask prices. So these are the prices at which other people are willing to sell. So it's also possible, for example, for you as an investor to buy bonds from other investors on Fidelity. And someone is willing to sell this bond, for example, at a price of 99.474. So you can see it's slightly higher than what people are willing to buy at. This is commonly referred to as the bid-ask spread. Now, say, for example, you are willing to sell this bond at the bid price of 99.472. In theory, we should expect if you put a sell order at this price that your order is going to be filled or executed. So say, for example, this bond, which matures on October 10th, you want to sell it right now for cash. To do that, you scroll down. Your action is sell. So now I'm going to sell. I happen to have 100 bonds or $100,000 of owned bonds here. So say if I want to sell all of that, I just type in the quantity here. Then I can choose either the limit price or the limit yield. Let's just go with the price. So let's say I want to hit this highest bid of 99.472. I can do 99.472. Or if I want to be a little bit more patient and I don't care about my order being filled right away, I can potentially put a price of 99.474, which is a little bit higher, but it's on the lower end of the asking prices. I could say I'm willing to sell at 99.474, which then means someone else has to be willing to buy at this price. This means you might not necessarily be filled. Then you can do either fill or kill. That means you put out the order, and if it's not immediately filled, the order is canceled, or you can choose the option of actually having that order sit on the bid-ask ladder here for the full day, and then the order is terminated if it's not filled by the end of the day. Then just go to preview order. You can see some of the details here. Again, it's 100 times $1,000 in face value, or $100,000 in treasury bonds. You can see the price at which you're willing to sell, and you can see what that means in terms of the effective annualized return from potentially someone buying at this price. You see it's fill or kill, meaning this order will either be filled immediately or it will be terminated. And then you can see the trade date is today's date of August 30th. And of course, the price times the total quantity you're selling, which is $100,000, gives you the cash that you receive from selling this bond, 99,474, which matches the price here. Now, one thing to keep in mind when you're selling a treasury bond is there is the possibility of the price moving up or the price moving down. Let me give a practical example of how the existing interest rates can potentially move the bond yields and the price at which you can sell a bond. So again, this bond was bought in July and is a 3-month bond. But let's say, for example, the Fed suddenly decided to cut interest rates. This would typically happen if the Fed views a high likelihood of recession and gets particularly poor economic data. They might want to cut interest rates to actually push up the economy and encourage people to borrow money. So let's say the Fed cuts interest rates, near-term interest rates, from around a little over 5 right now to 4%. So the 1-month Treasury bill, let's say, drops from a yield of 5.3 or so today to 4%. Remember, it's already been about a month and a half on this Treasury bill that we currently own. So this Treasury bill only has a month plus a few days left before it matures. So in theory, a person who invests in Treasury bills would be ambivalent between buying a new issue Treasury bill, which has a yield of 4%, versus our existing Treasury bill, which currently it shows here on the screen has a yield of 5.2%. So of course, people will buy existing Treasury bills because the yield is higher, and they will keep on bidding up the price of existing Treasury bills until the yield is probably around 4%. Otherwise, there's an arbitrage, right? You can basically buy existing bills at a higher yield as opposed to new bills at a lower yield for the exact same level of risk. Again, the risk is that about in a month's time, whether the US government is actually going to pay back the principal of the bill or not. Because it's almost the exact same instrument, because they have approximately the same maturity and the same amount of credit risk, what will happen is people will bid up the price of your existing bond, and you might actually be able to make money by selling the bond early. Now, the flip side is true. If the government, for example, increases the near-term interest rate, maybe because inflation data is particularly high, the near-term Treasury rate, the newly issued 1-month bill, will have a higher yield, and then as a result, people will sell existing Treasury bonds to instead buy the new Treasury bond, and the price of the treasury bond that you currently hold will actually go down. In that scenario, you can always potentially hold until maturity, where you'll be paid 100 cents on the dollar. That's the way you negate or get rid of interest rate risk, as long as you don't need that cash right away. These are things you have to take into account when you're actively buying and selling treasury bills, as opposed to holding them to maturity. I talk about this more in the bond video that I released on my YouTube channel. You can check on there where I talk about credit risk and interest rate risk. Hopefully that's a helpful overview on how to sell treasury bonds on Fidelity. Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.